Hey friends, Walt here with the Schultz team at Canopy Mortgage. I have a lot to go over in this video, but I really want to try to make it short, but also precise. I'm making this video and going to start sending this out here on a regular basis simply because of the misdirection and misinformation that I'm seeing from so many different people out in our industry, from the media and from a lot of other sources. I just saw just the other day, and I'm seeing articles all the time about interest rates and how, where are they going to be, the mortgage interest rates, and they keep alluding to, the media keeps alluding to the Fed as they lower interest rates here on Wednesday, that they have a direct effect upon mortgage rates, that mortgage rates will follow, and that simply is not the case. Let me actually show you here the truth behind it. So right now, we're really the same interest rate. This is the 30-year bond chart. We're really the same interest rates that we were back in February of 23 and December of 23. You can see that inflation hit us hard, that we had a massive sell-off in the bond market, where we hit around 8.25%, 8.25% in October of 23, November 23. We bounced off that. We started to improve. We then got worse, and then we've started to improve. Now, as we look at this chart specifically over the last 3 months, you'll see that we've been on an upward trajectory. And the higher the bond yield, the lower the interest rate. That's the way this chart works. So you can see that we've been on an upward trajectory here. If you want a copy of this chart, let me know. And as we're on an upward trajectory, that means that rates have been getting better the last several months. And they've really been getting better because of what the Fed has been saying more than what they have been doing. In fact, they haven't lowered the Fed funds rate at all yet. But our interest rates have been getting better. It's again, what they're saying, not what they're doing. So let's really look at what the Fed's job is. Now, their job is to oversee monetary policy. And how do they do that? They do that. And really, what does that even mean? Let me back up. What does that even mean? That means that their job is to make sure that our dollar is worth as much as it possibly can be. Now, how do they do that? They do that through the interest rate that they have a direct effect over, which is called the Fed funds rate. The Fed funds rate is the overnight cost of funds that banks charge each other to borrow money from each other, or that certain banks can go directly to the Fed and borrow money from the Fed. So that right now is 5.25% interest. Now, the banks charge a premium upon that then to lend the money out. That's called prime lending. So they charge 3% above the Fed funds rate. Prime lending is what all of our credit cards are based upon, all of our equity lines, home equity lines, personal lines, auto loans, they're all based upon prime lending. So they have a direct effect upon prime lending and what banks are going to charge there. Now, prime lending affects all short-term lending. So again, equity lines, personal lines, auto loans, credit cards. And the goal is that as the Fed raises or lowers the Fed funds rate, they're trying to spark the economy as they raise the Fed funds rate. They're trying to slow the economy down as they raise the Fed funds rate. And as they lower it, they're trying to spark the economy. There's some things right now that the Fed, that they're seeing and that they mentioned just not too long ago when they were in Jackson Hole, that they're concerned about. They're not as concerned about inflation. That tells the market that inflation is more in check. And we know that inflation's been on its way down. We can see that. But they also said that they're more worried about unemployment right now, or our employment for the U.S. So we're roughly 4.2%, which is considered full employment for the U.S., anything under 5. But they're worried that we're going to go above that we're going to start to really tick up. Now, as unemployment starts to tick up, that is a sign that a recession is coming. And it normally comes relatively quickly. And there's been some other signs in the market that a recession could be coming here anywhere in the next 2 to 10 months in there somewhere. So the Fed, as they are going to start to lower the Fed funds rate, they're going to try to spark spending, which will cause a little more inflation, but they're going to spark spending to try to help us ease out of a recession in a quick and timely fashion. Now, the question is how much are they going to raise or lower the Fed funds rate? Right now, the market's already baked in a 0.25% discount. Now, that's awesome. But over the weekend, there's been some news that there's a likelihood, in fact, it's a 65% chance likelihood, that they're going to lower the Fed funds rate 50 basis points. If they do that, they're sending a message to the market, to the stock market, that there's uncertainty ahead. The stock market hates uncertainty. As there's uncertainty ahead, if they lower by a quarter, it's going to be status quo. Our rates really won't change a great deal because it's already in the market. If they lower by a half, then at that point, our rates should go lower. Because again, that's the uncertainty to the stock market. The stock market hates uncertainty. The bond market then will be the beneficiary of that, as the stock market will sell off. People invest in mortgage-backed securities and our mortgage bonds, which then will drive our interest rates down a little bit more. So again, I'm going to send this out on a regular basis. You can look right above here where I've got the interest rates from Mortgage Daily News. I do not show the APR on there simply because I'm pulling it directly from Mortgage Daily News from their site. And so everybody has a variation of the same rate. If you want to know what your interest rate is, just give me a call. But otherwise, if you're a realtor and watching this, that's really what the base rate has been. And so rates are going to be pretty close to that as you follow Mortgage Daily News. And if you have any questions, please reach out. We're here to help and serve you in any way that we can. Thanks, guys. Have a great day. Bye-bye.